What if the age you retire is not actually the age you think it is? You have a number in your head, 60, 62, 65. But the system does not care about your number. It has its own timeline, its own switches, and if you flip them in the wrong order, you can lose money you will never get back. Before we go further, do one small thing for me. Hit like on this video, subscribe if you have not already, and send this to the one person in your life who keeps saying, "I'll sort my pension out next year." This is the video that saves them from a mistake they don't even know they're about to make. Here is the truth. Nobody tells you, plainly enough. Retiring between 60 and 66 is not one single moment. It is a stretch of years, sometimes 4, sometimes 6, sitting between the day you stop earning and the day the state pension finally turns on. And inside that stretch sit rules that most people only discover after they have already made the mistake. I want to walk you through this properly, not with fear, not with jargon, just with clarity, because clarity is the one thing this topic almost never gets. All right, let's start with the basic shape of the problem, because until you see the shape, none of the details make sense. Imagine your working life on one side and your state pension on the other. They are not joined together. There is a gap between them, and that gap has to be filled with something. Your own pension pot, your savings, maybe some part-time work. That gap is the entire challenge of retiring in this age window. The full new state pension currently pays £241.30 a week. That sounds simple enough until you realize state pension age itself is not fixed at 65 anymore, and for many people it is not even 66 for much longer. It is moving to 67, phased in between April 2026 and April 2028. If you were born between the 6th of April 1960 and the 5th of March 1961, your state pension age sits at 66 plus a handful of extra months. Born after the 5th of March 1961, right through to the 5th of April 1977, your state pension age is 67. That single fact changes everything about how you plan. If you think you're retiring at 62 with a 3-year gap before the state pension arrives, but you are actually looking at a 5-year gap, your entire funding plan is wrong before you've even started. Not because you did anything careless, because nobody sat you down and explained the actual number. This is where so many people slip. They assume that once they can access their private pension, they are financially sorted. But being able to touch your pension and being ready to rely on it are two very different things. Most private pensions can usually be accessed from age 55, depending on the scheme. Your state pension is an entirely separate machine with its own separate door, opening on its own separate day. One door can be open while the other stays firmly shut for years. So if you leave work at 62, you might be looking at 4 or 5 years, where every single pound of income has to come from somewhere else. Your workplace pension, a SIPP, an ISA, straightforward savings, maybe some part-time work if you want it. That gap is the real game of early retirement. Handle it well, and you glide through those years with room to breathe. Handle it badly, and you burn through your capital far faster than you ever intended, leaving your later years thinner than they needed to be. I've watched this play out again and again. People with a perfectly decent pension pot, no mortgage, sensible habits, nothing reckless about them at all, still ending up anxious in their 60s. Not because they didn't save enough, because nobody ever showed them the actual shape of those bridge years. They knew the number in their pension pot. They didn't know how much of it they could safely draw each year, what tax would take a bite out of it, or exactly how long that bridge really needed to last. That is not a failure of the person. That is a failure of explanation. And it's exactly what we're fixing right now. So let's clear up the first big misunderstanding, because this one catches almost everyone off guard the first time they hear it properly. Your pension pot is not entirely tax-free money sitting there waiting for you. You can usually take up to 25% of your pension as a tax-free lump sum, capped at £268,275 across everything you hold, unless you happen to have a protected allowance from years ago. The remaining 75% is taxable income the moment you draw it out. Picture a loaf of bread cut into 2 very different pieces. The first slice is free. Nobody touches it. The second, much bigger slice goes straight through the income tax system, exactly like a salary would. Understanding this before your very first withdrawal is one of the most important things you can do in this entire process. Here's what that actually looks like with real numbers. Say you retire at 63 with a pension pot of £180,000 and no other income coming in yet. You take your 25% tax-free lump sum, £45,000, leaving £135,000 still inside the pension. Now you decide to draw £15,000 of taxable income from that pot this tax year. If you live in England, Wales, or Northern Ireland, your personal allowance is £12,570. That means only £2,430 of your withdrawal actually gets taxed at 20%, a tax bill of around £486. Manageable, sensible, barely a dent. Now compare that to someone who panics or simply doesn't understand the system and pulls half their pension out in one single tax year. Suddenly they've pushed themselves into a much higher tax bracket for that year, handing HMRC a far bigger slice than necessary for absolutely no benefit to themselves. Scotland runs different tax bands entirely, so if that's where you live, the maths shifts again, and you cannot simply borrow an example built for England and assume it applies to you. The lesson underneath all of this is simple. Timing matters more than the total amount. The tax system looks at what came out of your pension within a single tax year. It does not care that you meant for that money to stretch across the next 4 years. It taxes what left the pot in that 12-month window. That's the mechanism. Sharp, but entirely predictable once you understand it. There is more than one way to actually take the money too. Here's what that actually looks like with real numbers. Say you retire at 63 with a pension pot of £180,000 and no other income coming in yet. You take your 25% tax-free lump sum, £45,000, leaving £135,000 still inside the pension. Now you decide to draw £15,000 of taxable income from that pot this tax year. If you live in England, Wales, or Northern Ireland, your personal allowance is £12,570. That means only £2,430 of your withdrawal actually gets taxed at 20%, a tax bill of around £486. Manageable, sensible, barely a dent. Now compare that to someone who panics or simply doesn't understand the system and pulls half their pension out in one single tax year. Suddenly, they've pushed themselves into a much higher tax bracket for that year, handing HMRC a far bigger slice than necessary for absolutely no benefit to themselves. Scotland runs different tax bands entirely, so if that's where you live, the maths shifts again, and you cannot simply borrow an example built for England and assume it applies to you. The lesson underneath all of this is simple. Timing matters more than the total amount. The tax system looks at what came out of your pension within a single tax year. It does not care that you meant for that money to stretch across the next 4 years. It taxes what left the pot in that 12-month window. That's the mechanism. Sharp, but entirely predictable once you understand it. There's more than one way to actually take the money too. Some people move into what's called flexible drawdown, taking their tax-free portion first and then drawing taxable income only as they need it. Others use a method where every single withdrawal is split automatically, 25% tax-free and 75% taxable, each time money comes out. Not every provider offers every option, which is exactly why the way you phrase your request matters. Ring your provider and simply say, I want the money, and you may get pushed down whatever path is easiest for them, not necessarily the one that suits you. Instead, ask specifically about your options for accessing the pension flexibly, and ask them to explain the tax implications of each route before you commit to anything. Those extra sentences slow the whole process down just enough to put tax on the table before any decision becomes irreversible. And if you're over 50 with this type of pension, there is free, impartial guidance available, specifically built for this exact conversation. It won't give you personal financial advice, but it is often the right place to start before you speak to anyone else. Now here comes the trap, the one that quietly catches sensible, careful people, and the one that, once triggered, cannot be undone. The normal pension annual allowance right now sits at £60,000. In plain terms, that's the usual yearly limit on how much you can pay into your pension with tax relief before a charge kicks in. But the moment you flexibly access a taxable income from your pension, a completely different and much smaller rule switches on. Your allowance for future pension contributions drops from £60,000 down to just £10,000. Not gradually, not next year. Immediately. Here's why that matters so much more than people expect. Retirement between 60 and 66 is rarely one clean, permanent stop anymore. People finish one job and pick up 2 days a week somewhere else. Or they take a year off, discover retirement is lovely in theory but strangely quiet by November, and go back to paid work. I've watched this exact pattern play out over and over. Someone draws a small amount of taxable pension income at 61 or 62, thinking it's harmless, just a bit of extra spending money. Then at 64, they go back to work and want to rebuild their pension savings properly. Too late. Their allowance is now capped at £10,000 a year permanently, and old unused allowances from previous years cannot rescue them from it. Now, in fairness, not every single withdrawal triggers this. Taking only your 25% tax-free lump sum on its own does not trigger the lower limit. Certain small pension pots are also exempt, but the moment you draw taxable income through flexible access, the switch flips permanently. That's why your very first taxable pound out of a pension is such a genuinely enormous decision. Most people assume the big choice in retirement is deciding when to stop working. Often, the far bigger choice is the exact moment that first taxable pound leaves your pension pot. One practical thing worth remembering here. Once you've triggered flexible access for the first time, your provider is required to send you a written statement confirming it, usually within a month. Keep that letter. Read it properly. If it never arrives, chase it. And if you're paying into more than one pension scheme, each of those schemes may also need to know this has happened, because the reduced allowance follows you, not just the pot you drew from. I'll add one honest caveat here too. Everything I'm describing mainly applies to defined contribution pensions, workplace pots, personal pensions, and PPs. If you have a final salary pension, the rules work differently, and the specific terms of your scheme matter enormously. This is genuinely a moment where speaking to a qualified advisor earns its cost many times over. Let's pause and gather what we've covered so far, because it's a lot and it matters. You are funding a bridge between work and your state pension. Your pension pot is not fully tax-free, and one badly timed withdrawal can permanently cut your future pension allowance by 83%. That's the plumbing of this stage of life. Before we move into the part that surprises almost everyone, and I mean almost everyone, do me a favor. If this has already shifted how you're thinking about your own retirement, tap that like button right now. It genuinely helps this reach the people who need to hear it before they make an irreversible decision. And if you know someone in their early 60s still working out their plan, this is the moment to send it to them. Now, the part of this most people in this age group have simply never heard, because the rules themselves are shifting under everyone's feet right now. At the moment, the earliest most people can access a workplace or personal pension without a heavy tax penalty is age 55. That's been the standard since 2010. From the 6th of April 2028, that minimum age rises to 57. And it doesn't rise gradually, it happens overnight on that exact date. If you were born on or before the 6th of April 1971, this change simply doesn't touch you. You'll already be 57 by the time the new rule lands. But if you turn 55 on the 5th of April 2028, you can access your pension that very day under the old rules, turn 55 the following day, and under the standard rules, you would normally have to wait 2 more full years. If you were born between the 6th of April 1971 and the 5th of April 1973, you sit in a particularly narrow window. You have from your 55th birthday until the 5th of April 2028 to access your pension under today's rules. After that date, unless something specific applies to you, untouched pension funds normally can't be accessed until 57. That something specific is called a protected pension age, and it's worth understanding properly, because it can genuinely change your entire plan. This protection attaches to the pension scheme itself, not to you as a person. It can apply if you were already a member before the 4th of November 2021, and the scheme's own rules, as they stood in early 2021, gave you an unconditional right to take your pension before age 57. Unconditional means exactly that. No permission needed from an employer, no discretion required from trustees, simply your right on request. Many pensions opened after that date do not carry this protection. Some older ones do. And critically, protection under one pension pot does not automatically extend to another pot you might also hold. Each one has to be checked individually with the provider directly. If you want the exact question to ask when you call your pension provider, it's this. Does my scheme carry an unqualified right to access benefits before the normal minimum pension age? And do I hold a protected pension age of 55 under this specific scheme? Write down their answer, the date you asked, and who you spoke to. 2 years from now, that written record could genuinely matter. Now we come to the change I believe deserves the most attention of everything in this video, because it is, without exaggeration, the single biggest shift to retirement and estate planning in over a decade. From the 6th of April 2027, most unused pension funds, along with pension death benefits, will be brought inside your estate for inheritance tax purposes. This is not a proposal, it is not a rumor. It received royal assent as part of the Finance Act 2026 on the 18th of March 2026. It is law. Let me explain what that actually means in real terms, because reading a headline doesn't quite convey the full weight of the change. For decades, one of the most powerful tools in estate planning was money left inside a defined contribution pension sitting outside your estate for tax. People would spend savings in ISAs first, keep the pension pot untouched, and pass it on to their children free of the standard 40% charge. This was not a loophole or a trick. It was legal, sensible, and widely recommended by financial advisors for years. That protection ends on the 6th of April 2027. From that date, most untouched defined contribution pension pots become part of your taxable estate. The current inheritance tax threshold, known as the Neal rate band, sits at £325,000. It is frozen until at least the end of the 2030-31 tax year. There is an additional allowance for homes passing directly to heirs. Above those combined thresholds, the tax rate is 40%. And here's the part that genuinely deserves your full attention. If you die after the age of 75, the remaining pot can be hit with inheritance tax first. Then, Whatever is left gets taxed again as income when your beneficiary actually draws it out at their own personal tax rate. For a child who is a basic rate taxpayer, the combined effective loss can run past 50% of the original pot. For someone in a higher tax bracket, it climbs even further. I won't hand you a single definitive number here because it genuinely depends on your own estate and your beneficiary's circumstances. What I will say clearly is this: the direction of change is unmistakable, and it is not a minor adjustment. Some things remain untouched by this. Transfers between married couples and civil partners stay completely exempt, exactly as before. Death and service benefits from registered schemes are still excluded. And if the pension holder dies before the 6th of April 2027, current rules apply. The principle, though, is fixed in law already. If you're in your early 60s, the assumption that your pension is the very last asset to touch needs a fresh look. I've seen this exact pattern repeatedly. People deliberately structuring their entire retirement around preserving the pension for the next generation. That strategy hasn't become wrong overnight, but the numbers involved look genuinely different from what they assumed even a year ago. Whether it makes more sense to draw your pension faster now or slower is a conversation that belongs with a qualified financial advisor. None of what we've covered today is secret information. It's all publicly available on government websites right now, but almost nobody goes looking, because almost nobody knows they should be asking these questions in the first place. That gap between information existing and information actually reaching the people who need it, that's the entire problem. So let's bring all of this together, not as a pile of things to worry about, but as something far more useful, a clear map. The years between 60 and 66 are genuinely their own distinct territory, with their own rules about bridge funding and state pension arrivals. It has its own upcoming changes to the minimum pension access age and huge shifts in how pensions are treated for inheritance tax. These are real decisions, with real financial consequences, and most of them need to be made before you actually hand in your notice. None of this needs to be resolved tonight, but it does need to be resolved before you switch off your income for good. The financial damage in this stage of life rarely comes from one big, dramatic, obvious mistake. It comes quietly, from not knowing which questions to ask. So where do you actually start? Check your state pension forecast and your national insurance record before you leave work. Call your provider and ask whether your scheme carries an unqualified right to access benefits before the normal minimum pension age. And if your total estate is likely to sit above roughly £500,000, have a proper conversation with a qualified specialist before April 2027. Your plan deserves to reflect the world as it actually stands today, not the world as it stood 5 years ago. One last thing before you go. If this video gave you even one thing you didn't know before, do 3 things right now. Like it, subscribe, and share it. I'd genuinely like to know something from you. What's the one thing about your own retirement that nobody has ever properly explained to you? Tell me in the comments below. I read every single one.